Hello, my name is Eric Diaz, and I'm here today to discuss my Peachtree Securities Inc. Case A with you. Why is the T-bond return in Table 1 shown to be independent of the state of the economy? And is the return on a one-year T-bond risk-free? Now, the T-bond return in Table 1 is independent from the state of the economy simply because it's risk-free. The U.S. Treasury issues these T-bonds, and meaning that these securities are backed by the government. So the U.S. Treasury must give a return of the 8%, regardless of the state of the economy. Um, because they're backed by the government, uh, T-bonds are considered to be free from default risk. Um, However, they're not completely risk-free due to the exposure of inflation and the existence of reinvestment risk. For question 2, calculate the expected rate of return on each of the four alternatives listed in Table 1. And for part B, based solely on expected returns, which of the potential investments appear to be the best? In this question, we have to calculate the expected rate of the returns for TICO, Gold Hill, S&P 500. So for TICO, I calculated 13.5% rate of return. For Gold Hill, 8.80%, and S&P 500, 15%. And just based on these expected returns, the S&P 500 seems to be the best out of all for potential investors. Its expected rate of return is 15%, so it's higher than Gold Hill, TICO, and the T-bond. For question 3, it states to calculate the standard deviations and coefficients of variation of returns for the four alternatives. Starting with A, what type of risk do these statistics measure? Is the standard deviation or the coefficient of variation the better measure? How do the alternatives compare when risk is considered? So for A, the type of risk that standard deviation measures is the absolute risk of specific securities or an entire portfolio. Coefficients of variation measure the amount of risk per unit of return. For B, standard deviation is also used to determine absolute measure of risk, and the coefficient of variation is used to determine the relative measure of risk. So in this case, it is better to use the coefficient of variation because with this measure, the expected value can be expected along with the amount of risk per unit of return. And based on the data, TECO would be the best alternative since it has the highest expected rate of return and the lowest coefficient of variation. Question 4. Suppose an investor forms a stock portfolio by investing $10,000 in Gold Hill and $10,000 in TECO. What would be the portfolio's expected rate of return, standard deviation, and coefficient of variation? How does this compare with values for the individual stocks? What characteristic of the two investments make risk reduction possible? And what do you think would happen to the portfolio's expected rate of return and standard deviation if the portfolio contains 75% Gold Hill? When calculating the expected return, standard deviation, coefficient of variation for Gold Hill and TECO at 10,000 each, 11.15% for the expected return was calculated. Standard deviation was at 2.89, and coefficient of variance was 0.26%. For part B, in comparison to the individual stocks, the expected return, the portfolio seems to be less risky. And this is largely due to diversification of the portfolio. The securities in the portfolio are negatively correlated. So what really makes risk reduction possible is the diversification of the portfolio. One of the securities could easily plummet in the market while another one could surge in value. So this is what helps maintain a profitable portfolio. Both of the portfolios shown for question 4 help decrease the standard deviation overall. However, they don't decrease the standard deviation and coefficient of variation as much as the first portfolio with 50% TICO and 50% Golden Hill. Now, for question 5, considering a portfolio listing of 10,000 in TICO and 10,000 in the S&P 500 fund, would this portfolio have the same risk reducing effect as the Gold Hill and TICO portfolio from the previous question? The portfolio would not have the same risk reducing effect as the Gold Hill TICO portfolio because the standard deviation is a lot higher than the portfolio in question 4. And they're not negatively correlated because they're positively correlated. So the S&P 500 has a high expected rate of return and standard deviation. So for S&P 500 and TICO, the expected return calculated is 14.25%. The standard deviation is 14.06%, and the coefficient of variation is 0.99%. For question 6, suppose an investor starts with a portfolio consisting of only one randomly selected stock. What would happen to the portfolio's risk if more and more selected stocks were added? What are the implications for investors? Do portfolio effects impact the way investors should think about the riskiness of individual securities? And would you expect this to affect companies' cost of capital? Explain the differences between total risk, diversifiable risk, and market risk. So to answer the first question, in this case, if more random stocks are added to the portfolio, then risk would decrease. It's ideal to diversify a portfolio rather than to depend on solely one investment. The implications for investors would be they would start to invest in portfolios with stocks that do not correlate. A highly diversified portfolio is less riskier. Portfolio effects definitely impact the way investors think about individual securities, however. It's just ideal for a well-diversified portfolio to leave less risk in an investment. As explained earlier, one stock in your portfolio might plummet while another one could rise in value. It's expected that cost of capital to be affected by some companies since there's lower risk. The cost of capital will also assume to be lower. Total risk is the sum of systematic and unsystematic risk. Market risk is simply risk of the market as an entirety, and diversifiable risk is risk that is correlated specific to a company or a stock. And there's no compensation for a single stock portfolio. It is simply high in risk to invest in a portfolio that consists of one single stock. Question 8. What is the required rate of return on TICO stock using value lines beta estimate of 0.6? So based on this, the required rate of return turned out to be 12.2% for TICO. The expected return is higher at 13.5. Now, because this is true, the stock is actually undervalued, meaning that this would be a great buy for investors since there's much opportunity for TICO to continue to grow. Question 9. What would happen to TICO's required rate of return if inflation expectations increased by 3%? uh, above the estimate embedded in the 8% risk-free rate. So in this case, if inflation expectations were to increase 3% above the estimate embedded in 8%, then that would mean that the required rate of return would also increase by 3%. So this would cause it to go from 12.2% to 15.2%. So what would happen to TICO's required rate of return if investors' risk aversion increased so that the market risk premium rise from 7 to 8%? So an increase in risk means that there's also an increase in required rate of return, meaning that the required rate of return would increase from 12.2% to 12.8%. And now let's assume that TICO's beta rose from 0.6 to 1. What effect would this have on the required rate of return? So in this case, the required rate of return would match the market to 15%. Now, part D, what is the efficient market of hypothesis? So efficient markets of hypothesis is an investment theory that states that investors will never really beat the stock market. So the impact it has on future investment decisions is that it can discourage investors from buying undervalued stocks. This theory does not apply to property and plant equipment, but the theory states that stocks are always trading at their true value. So a stock may be over or underpriced, and it could result in uncertainty for the cost of capital of a stock. So in regards to corporate financing, it does impact it. For the last part of this question, Jake Tyler should not be concerned about this theory when adding to his staff of security analysts. Honestly, it's a theory that can be ignored, and investors can continue to make money without ever having knowledge of this theory. Question 10. Suppose the ratio was projected to continue to decrease in 1993 and beyond. What impact would this have on TICO's riskiness, hence on its beta and required rate of return? So in this case, if the debt ratio were to continually decrease throughout time, then the riskiness of TICO company would decrease as well. This would mean that there would also be a decrease in beta and a decrease in the required rate of return on equity. So since TICO's riskiness will drop, it might become more attractive to investors.